geopolitics, trade policies, and energy security are top of mind for every global executive right now. How are these shifting global dynamics and climate regulation influencing investment strategies for clean fuel infrastructure?
What a great question. Um, they're not influencing it in a very good way. Okay.
Hello, and welcome to another episode of Interview with Experts. Today, we are focusing on a critical pillar of the global energy transition, the future of low carbon and renewable biofuels. I'm Sumit, and joining me today is an industry veteran with decades of expertise in gasification, engineering, and clean energy systems. Please welcome the Chief Executive Officer of SunGas Renewables, Robert Rigdon. Robert, it is absolute pleasure to have you with us.
Well, thank you for having me. It's my pleasure to be here to speak with you today.
Thank you. So, Robert, you have a remarkable background in industrial gasification technology. Looking back at your career, you have spent time as the VP of gasification technology at Texaco, served as a gasification director for industrial and chemicals at GE Infrastructure, and spent over 12 years leading Synthesis Energy System as president, CEO, and chief operating officer. So, Robert, what initially inspired you to pivot your deep expertise in gasification towards renewable fuels and biomass-based energy solutions?
Well, that's a really good question. Yeah, I've been working for 45 years now, and my early career, as you mentioned, was with Texaco, initially in chemicals manufacturing. And as my career advanced, Texaco began to get interested in very early years in the late 1980s and the early 1990s in alternative energies. So my initial interest in this began many years ago in, I would say, the early 1990s. And you see it's somewhat ironic, maybe an oil company is starting to look at alternative energy in the early 1990s. But that's sort of how far back the early thinking was going into being able to have more sustainable and cleaner. And a lot of the time, the thinking was back in those days around criteria pollutants reduction, less about renewables. And I was interested in participating in Texaco owned gasification technology and learning more about how this technology could help climate. But again, in the early days of gasification, it was largely about reducing criteria pollutants and bringing an alternative and diverse fuel source that could be another pathway other than natural gas derived fuels.
Right, right. So, having steered massive energy portfolios through different market cycles, how have your previous leadership roles at GE and Texaco shaped your approach to scaling SunGas Renewables today?
Yeah. Well, in deploying the two different technologies I've primarily been involved with was Texaco, which was later sold to GE, and I'm not sure if everyone remembers that, so I wanted to say it. So this is basically the same technology platform. And then I have been involved with commercializing fluidized bed gasification since my SES days and here at in SunGas. The ability to scale up started in gasification many years ago. And if we look at, for example, what we're doing at SunGas, our technology originated its development in the early 1970s. It's a fluidized bed type of gasification. As I've just stated, I have years of experience in entrained flow and fluidized bed, and they both scale very differently. So I'm going to focus on fluidized bed just for a moment. And as we scaled up these technologies, we started like any company in the 1970s with pilot units, and then as the years went by, commercial demonstration units. The first applications that were at large commercial scale were really on coal. And so we have built projects with this technology, or I have been involved with at SES and at SunGas, with building fluidized bed gasification technology based on the fluidized bed technology that has come out of the Gas Technology Institute in Chicago.
Okay.
I'll say more about that in just a moment, but so we've built a number of projects over that time period from when I was with SES and now in China on coal. We've built early renewable projects on biomass, and then we decided to start up together with GTI. GTI asked if I would lead the startup of SunGas in 2020 and focus exclusively on biomass type applications. So the things that I learned, to get back to your question, over those years was I learned a lot at GE. I have to say it's quite a remarkable company there. Right. And one of the things that I learned was that the importance of understanding your market and developing a product approach to being able to serve that market. And the product approach has to do more than just perform. It needs to be something that is reliable and bankable, financeable, in other words. Right. It needs to be supported by the company. It needs to have robust guarantees. And we set out, and we have spent and invested significant funds at SunGas developing a productized gasification platform for renewable applications. This is what we call our System 1000. And through that, we deployed all of the lessons learned that I've mentioned from our coal days through our biomass days in the early years, commercial plants that we've been running around the world, into the scale up and the productization of that. And then the last thing I'll say, the productization included not just the design, but also developing a supply chain that would bring in, there's a lot of components in these gasification. We design many of them ourselves at SunGas, but we also work with partners around the world to design some of them that are specialty items that are provided by others. So we actually built a supply chain as well.
Perfect. Yes. So, Rob, from an industry-wide perspective, how do you view this role of low-carbon biofuels in decarbonizing hard to abate sectors like shipping, chemicals, and potentially aviation?
Okay, look, the role is there's several aspects of your question that have to be taken, I think, seriously. The first is we realized in the early days of SunGas, and one of our leaders in the company, Mr. David Lamont, noted one day, he said, what we're really trying to do is we are trying to do in 20 to 30 years what the oil and gas industry had to do in 150 years. If you look at aspirations around the global market for decarbonization, the scale of energy, renewable, sustainable, low carbon, whatever you choose to call it, is very large. Okay, and so I think one of these items is scale, and of course there's a lot of challenges. I won't jump into the challenges of that, but we chose at SunGas one of the great benefits of thermal conversion technologies like gasification is that we can achieve large scale. And so what we have focused on is bringing the option of low carbon energy to into this sort of decarbonization efforts at a much larger scale. There are many smaller-ish projects and technologies that are not very amenable to scaling to large scale that are being looked at and thought about, but are probably not that viable in the long term. And we believe that scale is a key. So that was one of our first approaches to this. And then the last thing, and then we could talk more about regulations later. These are markets that are not going to emerge on their own. They will own, because this is generalizing. This is a more expensive renewable molecules. So let's separate electricity from, molecules for fuel and industrial usage are more expensive in today's landscape than traditional oil and gas alternatives, as you would expect, and significantly more. So the markets are not going to emerge without political will amongst countries that are interested in decarbonization and the alignment of regulations to set market demand signals in a way that will cause capital to form and these projects can be built.
Right. So what I understand is, the adoption rate is slower, right?
Yeah, it's slower, and I would say that again, generalizing this, it's led largely by Europe today. Not exclusively, obviously, but Europe has definitely been leading the way in setting a form of regulations to begin to drive market demand signals. But the regulations are still young. We are all learning how to navigate those. This is something we've done at SunGas with one of our big projects that we've worked on for several years. And the regulations are not yet, I don't think, in my opinion, mature enough to really catalyze the market.
Okay. So let's discuss the actual commercial pull of the market right now. There is a lot of discussion around timelines and adoption curves. So how would you describe the current pace of low carbon biofuel commercialization, and what primary factors are influencing customer acceptance today?
Look, I think the most fundamental thing for customers, and we said, well, who are customers? And really, and that's an interesting question in and of itself, but I think customers generally are going to be large capitalized companies that are operating in spaces that are going to fall into the requirement to decarbonize. And if you look at Europe, they would fall subject to penalties that would be placed on them if they do not decarbonize at a certain rate. And there's a lot of large operating companies, whether it's from shipping companies to airlines to gas companies to users of those fuels and all down the value chain. And so the first thing these potential customers are looking for is there has to be an alternative that's financially viable.
Right.
And once you've checked that box, then the next big concern is this has got to be energy that can come in at a meaningful scale. It can't just be some trivial amount of fuel molecules that really doesn't help them avoid penalties.
Absolutely. Yes.
All right. Yes. And then the third thing that really I think our customers are interested in is reliability of supply. And then it goes down into many other facets around as the market matures, tradability, fungibility of the products, but that's many years down the road. So it sort of sets up like that. And the most fundamental thing, again, is there a business case for moving forward at speed? Right.
So, we have seen a massive push for renewable methanol in maritime logistics, yet some talk of slower than expected adoption rate, But recently, SunGas announced the cessation of further development for the proposed Beaver Lake Biofuels Project in Louisiana. How did this slower than expected market adoption of low carbon marine fuels influence the decision to halt this project?
Yeah, that's a really excellent question there. We are in the early days of green molecules, low carbon green molecules. And we started the Beaver Lake project. It was, to my knowledge, was when we shut it down, the most advanced development in the Western world. I know China is working very hard on these molecules as well, but the most advanced in the Western world. And so your question, well, why did we choose to not move forward at this time? We started the project development 3 years ago. And 3 years ago, there was a certain amount of momentum in the market and appetite for these green molecules. As we fast forward to today, some things have changed. The momentum, number one, the momentum or the market demand signals for whether it's green methanol or other things did not accelerate as was expected over the last 3 years.
Okay.
For example, it was expected that the IMO would increase the requirements for lower carbon fuels through a decision it was planned to make last October in 2025, and that didn't happen. So that slowed the continual sort of trend up on market demand signals. That would have been a fundamental game changer. And then so I think that was really a significant weakness in market demand signals when that didn't happen. Secondarily, the company under the current sort of RED III Fuel EU side of the regulations, companies, and you mentioned the shipping sector, largely in the shipping sector, have also begun to learn how to meet the current requirements through other means. Some of them they're looking at lining up for some China methanol, which is still a little bit unclear how well that's going to come online. Mm-hmm. And then they've also been able to utilize LNG and other low carbon or carbon saving techniques to be able to stay within the thresholds that they need to stay under the current regulatory regime. And therefore, the growth of the market, we believe here at SunGas, is absolutely going to come, whether it's in shipping or it's in other derivatives like aviation fuel. But it has now just been slowed a little bit. The political will on a global basis is not as strong as it was, when we started the development of Beaver Lake. So I could add a little more color onto the Beaver Lake, because I should. It's not only the market demand signals. That was because we were very early, we were in a good position actually on being able to sell our methanol. Mm-hmm. We were an early mover. We were filling our book of methanol sales, even in the weaker market demand signals. So you might say, well, then what was the problem? Right. And it becomes a stacking of, I would say, risks. The projects, as I mentioned earlier, require significant economic support for these first generation of projects to be built. Okay. Because we're doing things, particularly like what we're doing at SunGas, where we are productizing and in a way that we can lower cost over time as we build more projects. The first projects are going to be more expensive. The European regulations generally do not provide much, if anything, in the way of incentives. They sort of provide penalties. And well, that's not, penalties are one thing they help sort of set market demand signals, but they don't really help get projects built. And the U.S. had a platform of incentives, and so we were reliant on incentives around carbon capture sequestration, which was very solid in many ways, and reliant on incentives related to the hydrogen production that we had in our syngas. Okay. And these incentives had, particularly hydrogen, have sunset dates on them. That's the 45, what we call the 45V incentive in the U.S. has sunset dates of the end of 2027. If you don't have your project well into qualified construction by then, you would not qualify for that incentive. So the project wouldn't be viable without it. Okay. So what I'm saying here is it was a combination of incentives in the U.S. and market demand in Europe that was making the project work. The market demand signals were weaker. The incentives in the U.S. are not going to be helpful for projects that are not going to go into construction before 2020 after 2027. Right. And then there are other risks that laid on. And so we realize now that we went from the early days of Beaver Lake, where the global appetite for renewable fuel molecules was growing and was very heated
Mm.
to a current environment where it's more muted, less alignment globally on the political landscape for doing this. And now the project could be quite viable, but we're a little early. So we believe that over the next year or so, a lot of the sort of lack of efficiency in the regulatory structure and lack of efficiency in the incentive structure will get resolved across 27 and 28, and projects like Beaver Lake will be able to be built just fine. So we decided we needed to pause it because the regulatory and market demand signals around the project weakened during the development of the project.
Right, right. So, given these types of project cancellation and delays across the broader clean energy landscape, what are the long-term implications for future global supply and market balance?
Yeah, see, I think so long term, it's all quite strong.
Okay.
And it's strong. Well, you have to sort of have a view that decarbonization is important. Okay. And now that in some ways there will be people that will come in and debate whether decarbonization is important or not. But if you set that aside for a moment and you sort of are in the mindset that decarbonization is important, then this is the very messy sort of exercise of cross-border cooperation on regulations, global cooperation on fuel and how it's going to be decarbonized. It affects economies in Europe. It affects economies in the United States and Japan and other countries. And there has to be some basis of agreement on how that's going to occur. But if you look at the demand and what decarbonization, we believe the speed of decarbonization needs to occur, the demand is literally off the charts.
Okay.
And this is we have a great technology product now to do this at scale, but we're in a good position. We're in many customers around the world. These large companies that are interested in being in the right position at the right time to bring projects online. And look, these projects can take 3 years of development before you're ready to even go into construction.
Right.
And so we have other things going on with other customers around the world to be ready. And we do believe over the next 2 years or so that a lot of the uncertainty around regs and misalignment will begin to improve. But we don't think it will be completely resolved, but it will begin to improve. And then the last thing I'll say is new products. The shipping industry stepped out in a very big leadership way in the 3 years ago with trying to decarbonize the shipping industry. Maersk was leading that at the time, that effort. But it's not only that now. I think we believe, and I think many others, that the need to decarbonize aviation fuel and to generate renewable natural gas at scale, we see these, and we see this through the pipeline of customers we work with as probably some of the most important fuel markets that we're going to be addressing, aviation and renewable natural gas.
Right. So, moving downstream to project execution, deploying these commercial scale plants requires massive capital allocation. So from your position at SunGas, what are the primary economic drivers that ultimately determine the commercial viability of a biomass to methanol project?
The big commercial drivers, obviously, and I won't go through the supply again, but the biggest obviously is you have to have a commitment of long-term offtake. Not just, so this is not intuitively obvious to a lot of us have been in energy industry all our lives, and we're used to energy being very fungible and tradable, and green molecules are not. So the early projects they need long-term, 10-year, committed, price solidified contracts to go forward. That's a big hill to climb, I will tell you. And so that's number one. And because you look at the scale of projects like Beaver Lake, and the balance sheet commitment is being made for 10 years of energy offtake is a big commitment.
Right.
And it's not even for a large company, it's a big commitment. So, and this is not normally how energy is sold around the world, not like that. And so, but you cannot really finance these projects unless you know you're going to be able to pay off your debt and everything. So you need these sort of commitments like that. So that's number one.
Right.
Number two is around the commercial arrangements. Largely, it's around the commercial arrangements around feedstock. One of the reasons we had picked the Beaver Lake project and the location is that in the United States, and the southern wood baskets are rich with abundant, high energy forestry residues that are, there's just millions and millions of tons of this available every year through sustainable forestry practices that are practiced in the U.S. So this project had a very good, solid, low risk feedstock supply. But when you look at siting these around the world, that's not always the case. And aggregating feedstock at scale, making sure the feedstock is commercially not going to be too expensive to prepare it to be used for gasification. So I would say that's probably the second. And then you get into many other derivatives. Capital cost, you mentioned, is important. Very important, and these are expensive, these early projects. At least in the one that we were doing, it was an expensive project, but we were managing it. We were able to manage it, and after the first projects are built and running, we will see, I believe, a 30% or more drop in total capital cost to build the next round, and then it'll drop from there. And you might say, well, why such a drop?
Right.
In the way the projects are coming together, the coverage of risk around price to build, the schedule to build, setting aside funds for performance if there's any issues when it starts up, that's a very big price tag. And so once the first ones are built, that risk is resolved. And to where that these projects are now more well understood, the supply chain's understood, certainly performances will be understood, and you will see the price take a step down. And then it will continue to go down as we mature supply chains and we get competition into the construction and so forth. So, but the early projects will need significant incentive support to get built if we're going to ever start this journey and build a lot of these.
Right, right. So, let's dive into the core engineering behind these transitions, which sits right in your wheelhouse, sorry. How exactly is modern biomass gasification technology advancing to help scale low carbon methanol production efficiently?
Okay. Well, one of the interesting things, at least from my point of view, and this is a question that we get often. In fact, sometimes I think it's almost a development mistake in how people approach projects. There is a sort of a general assumption that, wow, this is going to be a complex technology engineering exercise. How are we ever going to do it? The actuality is, it's not as complicated as what people think.
Okay.
Now, there's a level of complexity. The engineering in all of these projects is somewhat straightforward. And I say that because when methanol, let's take the case of methanol. Now, in the case of methanol, when we make green methanol molecules, and realize that, and as you look into the future, these green methanol molecules could be used in shipping, but they're also almost certainly going to be used with methanol to jet technologies to make jet fuel from green methanol. So methanol is going to be a fungible green molecule to make multiple products going forward.
Okay.
When we make methanol today in the oil and the gas, we use natural gas, and we convert natural gas to syngas before we make methanol, and then we make the methanol. And that whole flow sheet of syngas to methanol has been built hundreds and hundreds and hundreds of times around the world. Okay, so the taking of syngas to make methanol is as well understood as making power in a combined cycle power plant.
Okay. Okay.
And so then the difference is really around the gasification front end and just the basic integration of the gasification front end on from a utilities point of view with methanol production. And that's all straightforward. So the thing that we really have to pay attention to, and we did at SunGas, was integrating our System 1000 product. We had 3 System 1000s at Beaver Lake operating in parallel,
Okay.
making syngas that then made methanols. And then the rest of the project is rather straightforward, to be honest. So this is not an exercise in development. It is the thing that you're having to demonstrate that financial institutions, banks, and owners want to see is that you want to see gasifiers running at scale making methanol, and that's a legitimate request. And we have gasifiers running at scale making methanol in coal, which is, but it's not biomass, and it's almost the same, but it's not exactly the same. You know, we have to do a few things a little different when we're doing it, our gasifiers on biomass, and so we do it coal. So these are engineering differences, not technology development differences, but still, these are big investments. The Beaver Lake project is a $3 billion investment, and so yeah, it's large.
That's a huge amount, yeah.
Yeah, and so it is an undertaking that you've got to make sure you get it right. So I'll just leave you with, but the engineering is straightforward. It is manageable. And it becomes more of a financing risk exercise with contingent funds to make sure that financing is comfortable with that we've got risk covered, you know, when we start up one of these plants. So it's our product, our plant designs. We spend a lot of time making sure they're going to be financeable, and hopefully that message is coming across clear. It is not so much the engineering and technology, it's the making the engineering and technology financeable in the first round of projects.
Right.
Because there aren't really companies that want to stand behind these projects on their own. They want they're going to want constructors to do that, and constructors are going to say, well, I haven't built this before, so I don't know if I can stand behind it, and that sort of thing.
So, you know, Robert, how critical is the integration of carbon capture and storage to the actual sustainability metrics and the underlying economics of these projects?
It's essential. So in the case of the Beaver Lake project, it was, to give you some idea of scale, it was producing about 550,000 tons a year of green methanol molecules.
Okay.
While it was producing that, it was producing about 1.2 million tons a year of biogenic CO2. Okay. So a lot of, through the way the process naturally works, through the methanol production process section, CO2 is just sort of naturally segregated. And then, so that biogenic CO2, well, we've got 2 pathways for it. In sites where we have access to carbon capture sequestration, which we do largely in the U.S., particularly in the southern U.S. and around Louisiana and Texas, we chose that route, and it underpins the economics because your product price points. I won't get into so much the specifics, but I'll give you some general direction. If your methanol price today on fossil methanol is 100 units, your price on green methanol, you know, maybe, you know, 2x that. And so the how do you pay for that? And part of the way you pay for that is there has to be value on the fact that it's green. And the fact that it's green, that value is because of CO2. And when you sequester the CO2, you're literally taking the CO2 out of the atmosphere and you're permanently storing it in the geological formation. So you generate a a deeply negative
Right.
carbon intensity score, and that is valuable. Well, that is valuable in the landscape of emerging markets, but today, there are companies that there are no regulated real pathways for monetizing that CO2. There are companies that are voluntarily, taking positions in that CO2. So it's a very immature market, and it's tricky to monetize that CO2. The government gives you incentives, but you say, well, how else do I get it monetized? The people buying the fuel are not, because the regulations are not requiring you to decarbonize so fast. So they don't need it to be a low carbon, but they need it to be low, a negative carbon, but they need it to be low priced.
Right.
So that's how so it's essential. And then the other pathway, which is more technology complex, and it will come eventually, is to not sequester the CO2, take the CO2, combine it with hydrogen. Generally, it'd be like hydrogen coming off of electrolyzers. Take that CO2 and make more methanol at a very low carbon score, and then that'll have some economies of scale. But the production of hydrogen from electrolyzers is incredibly expensive and power hungry, and that just makes the building those kinds of integrated projects today in these early days a little bit too complex.
Right. Let's talk numbers and market competition. Commodity markets are adjusting rapidly. So what are the key underlying drivers expected to dictate renewable methanol pricing over the next 5 to 10 years?
Well, I think from a SunGas point of view, we believe that one of the key markets is actually going to be how methanol is deployed for aviation fuel.
Okay.
The aviation through the methanol to jet fuel technology pathways, which many companies have now and are recently going through ASTM certification, safety certifications, and so forth. And that's all. Some companies are done, and they're able to license and build that technology. So we think that's probably going to be the biggest driver for it. And this is because airlines, as long as airlines are required to decarbonize.
Right.
There aren't a lot of choices for airlines, and they need and the methanol to jet pathway is likely, at least as we see it now, probably one of the most economical pathways. And the other thing about it is green methanol can be made in places in the world where it is efficient to make it. Okay. And you can then have a very small, looks like a smallish chemical plant that would just take the methanol and convert it to jet fuel. And that can be located closer to airports and things like that, where it's a little bit more logistically friendly. So jet, we believe, is going to be one of the big market drivers, probably more than shipping, I think, in the long run. Okay. Shipping will be in there. Shipping is a different, has a lower pain threshold for fuel cost in running ships. And there's a higher value stream in aviation fuel, which will help the projects look better economically as well. So that's probably the number one market I see right now. And number two would be the general decarbonization of the natural gas infrastructure. There are, and look, what that means is renewable natural gas at scale. But regulations also have to allow the accounting form of mass balancing, where renewable molecules are put into natural gas pipeline systems, and they're accounted for, much like wheeling power around different regional areas, and they're accounted for buyers as they come out, and can take molecules out the other side. The regulations are not super friendly to that type of approach, but that needs to happen. And I say that market is a big market for the future, because natural gas is used to decarbonize. I mean, so many industries are users of natural gas. Right. And so it's an existing landscape of infrastructure around the world, Europe, US, that can be used. And in the regulation side, there's a lack of clarity here as well, because there are aspects of those that support regulations that want the gas infrastructure to actually shut down What we've looked at is the regulations today. A lot of them coming out of Europe have largely, and these are sort of my words, I don't think anybody has used this way sort of industry wide, but they've linked decarbonization with defossilization in the way they've written a lot of the regs. And when you do that, it means that you're not only building projects, you're having to build new infrastructure, and that's just super capital inefficient and doesn't work. And projects are not going to get built, in my opinion, if we continue that linkage. And then you may say, well, what are examples of that? For example, when we bring green power into the Beaver Lake project, we were not allowed to have the green electrons go over wires that are carrying regular electrons. The regulations say they have to be dedicated. When you think about that, that means I have to dedicate new power transmission lines, and I'm having to site large solar farms, and I can't site them in the best places. And so you can see, so I have to create new infrastructure, and that's a very big burden. And this goes down into the ability to do mass balancing around gas, do mass balancing around molecules. This is, but those two markets, SAF and RNG, we think are going to be some of the bigger ones. But underpinning SAF is methanol. Methanol, I believe, will be a fungible building block green energy molecule that's going to be used for many sources.
Right. So, geopolitics, trade policies, and energy security are top of mind for every global executive right now. How are these shifting global dynamics and climate regulation influencing investment strategies for clean fuel infrastructure?
What a great question. They're not influencing it in a very good way. Okay, I'll say that. The early days, the immaturity of the regulations have the investment community. There's plenty of capital. Let me start here. There's plenty of capital around the world. To build projects. We are not capital constrained. Or debt constrained. I mean, we're just not money constrained so much. What we are constrained on is how reliable are these regulations, and can we navigate the political, the regulatory, framework around the regulations to create durable regulations and reliable contracting structures around the projects. So the investment is ready, and investors, I would say, if I'm generalizing, are like, there's plenty of investment around the world. It's like, we're here to do this, but we're not even clear how fast it's going to come. Is it going to come at, as we look at every company's got their curves behind the scenes. They've got their low case, their base case, their high case. Which case is it going to be? And there's no certainty that there's even a base case yet. And how fast is the base case going to come? And so we've got to, as an industry, focus ourselves really hard, cross-border, on aligning, both incentives and penalties to create market demand signals and encourage investment to take the risk to build the first project. So, yeah, it's still a bit messy in the political regulatory landscape today in these early days. It's sorting itself out, and we believe it will. This is a natural process that we go through, but we're still pretty early.
So, if we look ahead to 2030 and beyond, so what major technological or policy developments do you expect will completely shape the low carbon biofuel sector?
Well, I think a couple of things. One is, as we go further out in time, around 2030, I mentioned biogenic CO2 and using it efficiently. We don't talk about this much, but I believe that we're going to need lower cost power generation sources at scale, because gasification creates a lot of biogenic CO2. And the the electrification to generate hydrogen from water needs a lot of low cost power, and it's got to be a low carbon power. That's not going to come from, in my opinion, renewables on the power side. The power scale for hydrogen electrification is just so huge. It's going to require nuclear power. So we believe that, or I believe a lot, and I think our companies sort of sees that if we don't have lower cost, it doesn't have to be nuclear, but we don't really see a lot of other pathways. If there aren't larger scale, whether these small modular reactors become more usable or larger plants are built. But if we're going to do this, we need to combine gasification with electrification to really hit large scale. And to do that, we can't, the power consumption is just so high that you're just not going to do that with solar panels and windmills. And so we've got to have something scale, and we're not going to be able to do it with natural gas. We're not going to be able to do it with coal, obviously. So that's just kind of where it leaves us today. And that's, I think, we'd look out at 2030. So a lot of it's about power, and then it's going to be about the market demand is, are we aligned in global politics for the rate or the pace of decarbonization? These are the things that are going to set that tone. And if we are, then we're going to have to get serious about power generation at scale that's green. And then today, really, gasification will play a big role in this. And not just our gasifiers will play. There's huge markets. There's room for many companies to participate in it, but it will play a large role. And it won't be, this is not going to be like the oil and gas industry in that it is sort of a one type of energy approach fits all needs. This is going to be a layering of different technology pathways. So what I'm describing is more of a molecule pathway for molecules. General electrification will have a combination of renewables and nuclear, and that's got to happen anyway. There's going to be a layering of many other technologies. Some will be at smaller scale, and that's okay. But we have today no clear pathway to doing this at scale with sort of one just fundamental type of technology. It's going to be an amalgamation of many things.
Right. Finally, Robert, what closing message you would like to leave with the policymakers, investors, fuel producers, and industry stakeholders listening today to this podcast who are driving the transition to low carbon fuels?
The message I would leave is that industry needs to have an arm-in-arm approach with regulators in being able to navigate and set regulatory incentive and penalty platforms and approaches that are workable. Well, let me add one more to that. Industry that includes not only the energy industry, but the financing industry and the regulators have to work together to set the regulatory framework that works. That's the most important thing that needs to happen. And I think we need more focus on getting sort of financing industry and regulators in the same room, getting on the same page. And then I think we can get something that's more efficient and works better.
Makes sense, yes. So, Robert, your transition from traditional gasification leadership to driving biomass to biofuel innovation offers an incredibly clear blueprint for where the industry needs to go. Thank you so much for joining us today and sharing these vital insights.
Well, thank you very much. I surely enjoyed it.